Hello class, my name is Sam Dykes. This chapter will be covering pages 5 through 8, and chapter 5 covering corporate taxable income. What we will cover, the corporate tax formula versus the individual tax formula and what changes those can take into account, accounting periods and methods, book tax difference, federal tax expense, and dividends and the role they play in income. So the corporate tax formula versus the individual tax formula, I left it on the right of the screen over here so you can take a look at it, but the main gist is the corporate tax formula is similar to the individual tax formula, but corporations don't itemize deductions. Corporations with annual gross receipts of $26 million or less over the prior 3 tax years can choose to use cash or accrual accounting. The main difference with cash versus accrual accounting is cash recognizes the receipt of a sale or an expense when cash is paid or received versus accrual when the event actually occurs. Generally, accrual is what is most widely used in the accounting world. All public companies are required to use accrual. Cash is more for your small local family businesses that you see around. Accrual accounting methods. Also, um, there's deferred expenses and deferred income that show. That's how they typically go about showing the difference. And they also have AR and AP listed on their financials versus cash, which is not because you only recognize the event when cash is received or paid. Accounting periods and methods. An accounting period is a tax year for a business. It's important to note, though, that this does not need to follow a calendar year. A fiscal year end could be any 12-month period. Um, I work in banking, so several of the companies I see actually have a 6/30 year end, so 12 months for that or 9/30. When choosing an accounting method, it is not only important to choose cash versus accrual, but it's also important to really think about what depreciation methods you're going to use. Are you going to follow FIFO or LIFO for inventory? Or you can use straight line or accelerated. All of this plays into what your tax liability is going to be at the end of the year and what your financials are ultimately going to look like. FIFO, obviously, we've learned about being first in, first out for inventory, LIFO, last in, first out, and then specific identification. A lot of small sale but high value item companies, such as like a luxury watch dealer or a car manufacturer or car dealer, will use this type of inventory method when recognizing the sale of inventory and reporting it as COGS. So favorable book tax differences. A favorable book tax difference is one that requires subtraction from book income in determining taxable income. This would be considered favorable because it reduces a company's tax liability at the end of the year. And it's important to note that book income and cash income are two different things. With book income almost always being lower than cash income, the best way really that most businesses determine cash income, and I'm using that term to define the actual true cash position of a business, would be EBITDA, earnings before interest, taxes, depreciation, and amortization. Um, Solely because depreciation, amortization, um, are not cash expenses, but are reported within the P&L to lower the company's overall tax liability at the end of the year. And then on the right of the screen, just have some examples of what this would be. So interest income on municipal bonds, income includes book income, but excludes from taxable income for regular purposes. This would be favorable. And death benefit from life insurance on key employees. Income included in book income, but excluded from taxable income. This would be also favorable. An unfavorable book tax difference. An unfavorable book tax difference is any book tax difference that requires an add back to book income in computing taxable income. This type of adjustment is unfavorable because it increases taxable income relative to book income. And this would be unfavorable because it would increase a company's taxable income liability at the end of a year. And then on the right, I have some more examples of this that would be seen as unfavorable. Common permanent book tax differences. A book tax difference are for items of income or deductions for either book purposes or tax purposes during the year, but not both. Permanent differences do not reverse over time, so over the long run, the total amount of income or deduction for the item is different for book and tax purposes. Again, this is taken straight from the book, but more examples on the right of the screen. Common temporary book tax differences. Temporary book tax difference reverses over time such that over the long run, corporations recognize the same amount of income or deductions for the items on their financial statements as they recognize on their tax returns. Federal tax expenses. Corporations deduct federal income tax expense called provision for income taxes in determining their book income. Typically on a company's audit, this would be one of the last items that you'd see down the P&L, right by net income, and is shown as what they believe that they will be paying in taxes at the end of the year. This is determined under Accounting Standard Codification 740. The book tax provision acts as a permanent difference in the corporation is recording after tax book income with taxable income. So an example from this, assume that PCC's audited financial reporting income statements indicate its federal tax provision is $2 million. What is PCC's book tax difference for the year associated with this expense? Is the difference favorable or unfavorable, or is it permanent or temporary? The answer to this is $2 million unfavorable and permanent book tax difference because PCC is not allowed to deduct federal income tax expense for tax purposes. Dividends, there's really 3 different rules to this depending on various ownership of the company and how you recognize dividends and income. So if the receiving corporation owns less than 20% of the stock of the distributing corporation, the corporation includes the dividend income as income. If the receiving corporation owns at least 20% but not more than 50% of distributing corporation stock, the receiving corporation usually includes a pro rata portion of the distributing corporation's earnings in its book income under the equity method of accounting and does not include the dividend in its income. If the receiving corporation owns more than 50% of the distributing corporation's stock, then the receiving corporation and the distributing corporation should have their financial reporting books be included as intercompany and eliminated, and the financials should be consolidated. An example, assume that PCC owns 30% of the stock of BCS, a U.S. corporation, and applies the equity method of accounting for book purposes. During 2019, BCS distributed a $40,000 dividend to PCC. BCS reported $100,000 of net income for 2019. Based on this information, what is PCC's 2019 book tax difference relating to the dividends and its investment in BCS? Is the difference favorable or unfavorable? The answer is $10,000 unfavorable book tax difference. In conclusion, corporations do not have a standard deduction or itemized deductions. Corporations must choose their accounting method, depreciation method, and inventory methods in a strategic way to reduce taxable income at the end of the year. Net income and cash income can be 2 different things. Best way to estimate this would be EBITDA. And then favorable versus unfavorable differences result based on their taxable effect. And these are the sources I use. So our textbook, and then 2 from Investlopedia relating to EBITDA, great article for those trying to learn how to understand what that measures, and then the difference really between cash accounting and accrual accounting. Thank you.